Hello, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of September 30th, 2024. I'm so glad you could join me today. This summer, the U.S. economy continued to grow steadily thanks to strong consumer spending. At the same time, inflation has been steadily moving closer to the Federal Reserve's 2% target. However, the rising unemployment rate has raised concerns that the labor market might be cooling off faster than expected. Looking ahead, healthy consumer spending should keep the economy growing at a stable pace into 2025. And since we're not seeing any major warning signs in the economy's key cyclical sectors, a near-term recession doesn't seem likely. Cooling inflation has allowed the Federal Reserve to shift its focus more toward the labor market. In response, the Fed joined other global central banks in September by cutting rates by 50 basis points. While the Fed's projections suggest that there could be 2 more rate cuts this year, how fast they cut rates will depend upon upcoming data. Even with these cuts, it looks like interest rates will still remain higher than what we've seen over the past decade, barring any major economic surprises. As for the markets, they've had quite a ride this summer. August saw a spike in equity market volatility thanks to weaker earning forecasts from the Magnificent Seven companies, some disappointing economic data, and policy moves from the Bank of Japan. But things have calmed down recently with improving earnings growth and expectations of more rate cuts pushing markets higher and leaving stock valuations elevated. Bonds have rallied too, and yields are now lower than they were at the start of the year, meaning that bonds have appreciated in value. Of course, with the U.S. election just around the corner, ongoing geopolitical tensions, and the Fed focused on adjusting its policies, risks remain that could keep markets volatile and potentially push the U.S. into a recession, although not very likely. In this quarter's review, we'll take a look at how the economy and markets have been performing, especially in terms of growth, jobs, and inflation, and how these trends are shaping future monetary policy. We'll also touch on global growth trends and discuss what all this means for investors. With markets near all-time highs, it's important to stay invested, but also to manage risks. Any successful investment strategy starts with understanding these big picture trends. So to help us out, we'll be using JP Morgan's Guide to the Markets. Feel free to pause the video at any time to take a closer look at the slides. Let's dive in and explore what's happening in the markets and economy together. After a slow start to the year, the U.S. economy picked up speed in the second quarter, growing at a 3% annual rate. A big driver of this growth was businesses restocking their inventories, but underlying demand was strong, with consumer spending increasing by an impressive 2.8%. That said, some indicators like the Purchasing Managers' Index and employment figures are starting to cool off, sparking concerns about a possible recession. However, when we look at the cyclical sectors of the economy, we don't see the kind of excesses that usually lead to a downturn. We like to call this slide the 4 horsemen of a recession because these sectors often signal if a bubble is forming. Right now, none of these sectors look overheated. Residential investment and vehicle sales are near average levels, indicating there's no overbuilding in housing, and consumers are in pretty good financial shape. Business spending is also steady, even with all the excitement around AI. In short, the risk of an economic shock coming from these sectors seems low. That said, with the U.S. election just weeks away, critical shifts in monetary policy on the horizon, and ongoing geopolitical tensions, external risks remain that could tip the economy into a mild recession. After a rocky start to the year, inflation has made significant progress in cooling down over the past few months, giving the Federal Reserve more confidence that it's on track to hit its 2% target. Disinflationary trends continued in the third quarter, with headline CPI inflation dropping to 2.5% year over year in August, the lowest level we've seen since early 2021. Prices for core goods have fallen for 6 straight months thanks to well-managed supply chains, even in the face of geopolitical tensions. This trend should remain stable.
On the more volatile side, gasoline prices dropped over the summer, helping to lower energy costs, while food inflation has stayed mild. With global demand still sluggish, it's unlikely we'll see big price jumps in either of these categories anytime soon. Now let's look at the stickier parts of inflation: shelter and auto insurance. Shelter costs make up more than a third of the CPI basket and have stayed stubbornly high compared to pre-pandemic levels. However, real-time data on market rents suggests that we'll see more normal shelter inflation going forward. Auto insurance has been another inflation hotspot, rising over 16% year over year, though it has eased a bit recently. As vehicle prices continue to stabilize, we should see auto insurance inflation decline further. Overall, inflation is expected to keep easing into 2025. While shelter and auto insurance costs are still elevated, real-time data shows that price pressures are cooling. With other disinflationary forces like easing wage pressures and steady supply chains, inflation could reach the Federal Reserve's 2% target by the end of this year. After the pandemic, demand for workers surged while the supply of labor was tight, creating one of the strongest job markets we've ever seen. However, as this slide shows, labor demand has mostly returned to more normal levels. One key measure of labor demand is the number of job openings reported in the JOLTS report. After peaking at 12.2 million in March 2022, job openings have steadily decreased, with 7.7 million reported in July 2024. This has brought the ratio of job openings to unemployed workers down to 1.07 times, now below 2019 levels. People are also quitting their jobs less often as the job market has loosened, making employees more cautious about switching roles. That said, other data show the labor market is still in good shape. Layoffs remain historically low, and initial claims for unemployment benefits have settled back down after a temporary spike due to weather disruptions and unexpected auto plant shutdowns this summer. In fact, unemployment claims are now lower than they've been more than 80% of the time this century. While labor demand has returned to normal, it hasn't dropped to worrying levels. Job openings are still higher than at any time before the pandemic, and low layoffs suggest that businesses are confident enough to hold on to their employees. Overall, while the labor market is softer than it was in the last couple of years, it remains healthy, and steady economic growth in the coming months should continue to support hiring. When it comes to the labor market, investors are keeping a close eye on one key measure, the unemployment rate. After hitting a low of 3.4% in April 2023, unemployment has gradually risen, reaching 4.3% in July before dipping slightly to 4.2% in August. Even at these levels, the unemployment rate is still lower than it has been 88% of the time over the past 50 years. However, the July jobs report did alarm some investors. With the jump to 4.3%, it triggered the Sahm rule, which suggests that if the 3-month average unemployment rate rises by 0.5% from its 12-month low, a recession could be starting. While rising unemployment due to layoffs would be worrying, it's not what's happening right now. Layoffs and jobless claims remain near historic lows, meaning the uptick in unemployment is more likely a sign of the labor market returning to normal after an extended period of unusually strong demand for workers. Nonetheless, loosening labor market slack has also led to a moderation in wage growth. After peaking at 7% in March 2022, growth has continued to slow back to trend. Wages rose 4.1% year over year in August, just above the 50-year average of 3.9%. While this is likely slightly above what is consistent with the Federal Reserve's 2% inflation target, softening labor market conditions should help wage growth ease, bringing inflation down with it. Here's a new chart in the Guide to the Markets to help us better understand consumer spending and saving, and I'm really excited to share it with you. The left side of the chart shows the real story of how consumer spending has evolved to this point and where it currently is. It shows year-over-year growth for durable goods, goods that are not used up immediately like furniture, non-durable goods, goods that are consumed in a short period of time like food, and services. In 2019, they were all growing at 2 to 3%. Then in 2020, with the lockdowns, consumer spending for durable goods saw an increase while services decreased. Everyone is buying Pelotons and stocking their pantries. When you have such a burst in spending, but not in the supply of goods, coupled with an increased money supply from government deficit spending, you get the perfect storm for increased inflation. In 2021, we see the effects of the government stimulus with massive increases in all areas of spending. In 2022, inflation spiked to over 9%. We have supply chain issues, and government aid is running out. Spending on durable goods declined, non-durable goods were flat, and spending on services was still higher than before the pandemic. In 2023, the supply chain issues have improved, and spending is coming back closer to pre-pandemic levels. However, non-durable spending is at 1%, telling us that there is a real squeeze on lower and middle income households. Now in 2024, we're back to more normal spending and a more normal economy. Inflation has come down, supply chains have normalized, and we've had a huge wealth surge. We've seen $50 trillion of wealth added in the last 5 years in the way of higher real estate and stock value, which really powers spending. We've had 17 consecutive months where wages have grown more than consumer prices. So the increase in real wage income and still low unemployment has put income in the hands of lower and middle income households. This shows how the economy is in a good place. On the right side, we see that although consumer spending is strong, consumer saving is below the historical average. This suggests that consumers are still a little stretched. The data are through September 30th, so there's still 3 months left in the year to see savings push closer to the longer-term average. At their September meeting, the Fed cut rates 0.5% or 50 basis points, the first rate cut since March 2020. Here's another new chart from the guide. Let's start over here on the right with the return of the U.S. Treasury 10-year bonds. The chart shows the year that the rate cut took place where the lines intersect, indexed to 0. So each year has the same starting point. Then we look back 12 months and track it forward for 24 months on the right. Since this just occurred, the 2024 rate cut line is at 0. Historically, for fixed income, all 6 rate-cutting cycles were slowly increasing as they looked forward to an increase in bond prices, which usually happens when the Fed cuts rates. Good performance for fixed income. On the left, equities, represented by the S&P 500 index, however, had 2 rate-cutting cycles that were at a worse place 24 months later, 2001 and 2007. But the real tiebreaker is how the economy and profits are doing. So in a recession, equities tend to go up. Recession, equities tend to have a tougher time, like in 2001 and 2007. Here's a slide that we haven't looked at for a few quarters. The National Bureau of Economic Research, or NBER, officially determines whether or not we are in recession. This chart shows their prime metrics, which measure the percentage change month to month in the heat map style, green for increases, red for decreases, and yellow for little to no change. In recent decades, the 2 measures that they have put the most weight on are real personal income less transfers and non-farm payroll employment. As you can see, real personal income has had only increases or remained relatively flat every month since December of 2022. Non-farm payrolls has only had increases or little to no increases every month since April of 2020. However, industrial production just saw a bad month last June, but has increased 0.4% in the last 6 months. Although economists are always looking for signs of recession, the data that determines whether or not we're in one is not depicted in the data. With the election just weeks away, is an appropriate time to remind us all to not let politics affect the decision of whether or not to stay invested in the market. This chart shows consumer confidence by political association rated as excellent or good. During the Obama era, Republicans did not feel positive about economic conditions, with only 5 to 20% ranking the economy as good or excellent. By contrast, Democrats felt more positive with 5 to 45% higher ratings. During this period, the market had an average annual return of 16.3%. However, in the Trump era, Republican sentiment outweighed Democrats, while the market returned 16% annually on average. There are many opinions in network and cable news, as well as social media, that can affect our outlook on the economy. The purpose of these quarterly videos is to educate viewers about the health of the economy and markets using economic data and unbiased opinions. Bonds had a strong third quarter, rallying over 5% as softer economic data and more cautious commentary from the Federal Reserve led markets to increase their expectations for rate cuts. Even after this rally, bond yields across many sectors remain attractive compared to the past decade. As this slide shows, most fixed income sectors are offering yields above their 10-year median levels. Core fixed income currently offers yields around 5%, while riskier options like high-yield bonds are providing about 7%. While credit spreads in both investment grade and high yield are somewhat tight, corporate fundamentals remain strong. In a stable growth environment, these tight spreads are unlikely to be a major concern, and investors can still take advantage of the attractive yields available. It's tough to make big bets on bond duration after the recent rally, but bonds can still help diversify portfolios, especially if lower rates come alongside a recession. Even if rates don't drop, bonds can still generate solid returns through their high coupons, and the current yields provide a nice cushion that can help protect against potential losses if rates do rise. As the Federal Reserve moves further into its rate-cutting cycle, the chance for big gains in bonds may shrink, so locking in these attractive income levels while they last is key. With inflation steadily returning to 2%, the Federal Reserve has shifted its focus to the job market, hinting that the Fed may follow other global central banks in easing policy. In its much-anticipated September meeting, the Fed kicked off its rate-cutting cycle with a 50 basis point cut, bringing the federal funds rate down to a range of 4.75 to 5%. While some might see this large cut as a sign of concern about the economy, the Fed's updated projections still anticipate a soft landing. They expect steady growth of around 2% over the next 4 years. Although unemployment forecasts for 2024 and 2025 were adjusted slightly higher, inflation forecasts for the same periods were revised lower. With its focus on the labor market, the Fed has moved up the timing for rate cuts, predicting 2 more cuts this year and 4 more in 2025. Currently, market expectations are more optimistic than the Fed's, suggesting that interest rates could rise modestly if some of the expected rate cuts don't happen. However, the long-awaited rate-cutting cycle has begun, and while the pace of cuts will depend on incoming economic data, interest rates are expected to remain at higher levels compared to the past decade, unless there's a significant economic shock. U.S. equities have seen impressive gains, with the market up around 50% since the beginning of 2023. However, most of these gains have been concentrated in just a handful of stocks. If you exclude the 10 largest stocks in the S&P 500, the overall return drops to about 20% during the same time period. As shown on the top right, these top performers have become an even larger part of the index, meaning that future returns will depend heavily on how well these few companies do. On the left, we can see that these top 10 stocks are also the most expensive, with a forward price-to-earnings ratio of over 30 times earnings. This means that not only do these stocks have a big influence on the index, but their high valuations could lead to significant drops if their earnings don't live up to expectations. That said, the reason these companies are in the top 10 isn't random. It reflects their strong business performance. The chart on the bottom right shows us that these companies generate a large share of free cash flow and operating income, and they invest heavily in R&D, which suggests their competitive advantages could keep growing rather than shrinking. Encouragingly, the rally has already begun to spread to a wider range of stocks, and earnings growth outside of the dominant companies turned positive in the second quarter of 2024. If economic growth stays on track for the rest of the year, as we expect, we should see more gains spread across the broader market. In this environment, an active approach could help reduce concentration risk by shifting some investments toward underappreciated opportunities. The global economy has performed better than expected this year, despite some areas of weakness. The U.S. and emerging markets, excluding China, have seen solid growth, while Europe, especially its manufacturing-heavy economies, may continue to face challenges. Germany, the largest economy in Europe, is struggling with structural issues in its manufacturing sector due to higher energy costs and increased competition, particularly in the automotive industry. However, the strength of Southern Europe's service-based economies, such as Italy and Spain, is helping to balance out some of this weakness. Looking ahead, expected rate cuts from the European Central Bank could ease the pressure on both businesses and personal lending, which could help boost economic activity. In China, the real estate sector continues to drag on growth, with inflation close to zero and domestic demand remaining weak. However, government stimulus and interventions could improve sentiment and help stabilize growth around the government's 5% target. Elsewhere in Asia, Taiwan and South Korea are benefiting from renewed strength in the electronics sector, and India's favorable demographics and business-friendly policies are expected to support its growth in the long term. Overall, this year is shaping up to be a good one for the global economy, which has so far avoided a recession. As central banks around the world continue to normalize their policies and inflation eases without significantly slowing economic activity, global markets should continue to trend higher. U.S. equities have outperformed international markets for a long time, making many U.S.-based investors hesitant to allocate abroad. While U.S. equity performance has been strong, it has also led to U.S. stocks making up an unprecedented 64% of global equity indices. This heavy concentration exposes passive investors to risks specific to the U.S. market, such as high valuations. In contrast, valuations in most other major markets are more attractive, often in line with or below their 25-year averages. The exceptions are the U.S. and India, where strong enthusiasm and robust earnings growth have pushed valuations higher. Overall, international equities are trading at attractive discounts and offer higher dividend yields compared to U.S. stocks. As shown in the chart, international equity valuations are more than 2 standard deviations below those in the U.S. Plus, international stocks offer 1.7% higher yields. With interest rates likely to remain higher than the last decade, international markets may have more potential for outperformance. With favorable valuations and growth prospects emerging in several regions, there are plenty of appealing opportunities abroad. As we wrap up this quarter's review, let's examine the matrix as of September 30th, 2024. U.S. large-cap equities continue to dominate the landscape, achieving a robust year-to-date return of 22.1%. This performance continues to lead the pack, much like last year, followed closely by emerging market equities with a return of 17.2%, real estate at 14.2%, and developed market equities at 13.5%. All asset classes are positive year to date, and even cash on the sidelines returned 4.1%. The traditional 60/40 stock bond portfolio returned 12.3%. There you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.